Uh, Welcome to Principles of Accounting 1. Happy to have you with us here in the eighth week. We are in our midterm week, which is why we're holding this class virtually. Understand that a lot of you are very, very busy this week, including myself. And so I wanted to make sure that we all had the opportunity to participate in today's lecture as we talk about cash, fraud, and internal control. Before I jump into today's discussion, I want to call your attention to the classroom. Here we are in our classroom in week 8. We actually have 3 action items that we have to take care of this week. We have, in addition to the chapter quiz, week 8 quiz, we also have on LinkedIn Learning Excel for Accountants certificate, and we have the midterm exam. I know, I'm sorry, it's a lot of work to be done in this week. I'm aware of that. Again, I apologize for that. The reason why it's important that it's designed this way is because of that midterm. We have one chapter per week, and the certificates really do a pretty good job of following the content and where we are in the class. So that's why we have the LinkedIn Learning plus the certificate plus the quiz and the midterm exam. So again, I apologize about the busyness of this week. We do have those 3 action items to complete. Um, so again, I apologize for the busyness, but if you could do your best to complete all 3 of those, that would be awesome. Definitely the midterm exam must be completed by Sunday night, and as well as the Chapter 8 quiz. My recommendation for success here is for this week, at minimum, complete the Chapter 8 quiz like, I don't know, today, tomorrow, definitely by Thursday, and then take the midterm exam, closer to the end of the week. You'll also notice that I've LinkedIn. I put in a link to a midterm exam review. That's a video, okay, and it follows the midterm exam precisely as it is. So my other recommendation for success of the midterm exam is to review that video before taking the exam. I assure you that if you do that, you'll score very high on the midterm exam. So please heed that advice. I think you'll be fine. Questions on any of that before we jump into the presentation? We good? I take your silence as being good. So, okay,
All
great,
good.
awesome. Thank you, Stefan. Appreciate that. All right, let's go ahead and jump into our conversation on cash fraud and internal controls. And I just lost my controls, speaking of which, so I can no longer see that part of the screen. So, okay, great, I can see it now. Uh, I'm just going to jump around a little bit. I apologize. Okay, uh, let's talk about cash fraud and internal control. Last week, I had mentioned that cash is king, right? I emphasized that importance in our lecture last week because cash rules the day, especially when it comes to business. That's how we operate. We operate on cash. Without cash, we don't have a business. I need cash to start the business. I need cash to run the business. I need cash to pay my employees, to purchase inventory, to operate the business, right? To start the business and operate the business, I need cash. Cash is king. So we're going to talk about cash and its applications. Just like we did last week, we talked about the cash general ledger, the uses of cash, etc. We're going to talk a little bit more about that today, but we're also going to introduce concepts of fraud and internal control. And I'm going to give you examples from my experience because I think it's important that you learn from what I've experienced about these topics in order to protect yourselves. Because I can tell you with certainty that there are issues with cash. What I mean by that is, we experience a lot of flexibility when it comes to cash. Cash is very liquid, like we talked about last week. Cash is very liquid. Cash can get lost very easily. So it's important that we talk about fraud and internal control as well when we talk about cash. And I want you to learn from my experiences that I've had. So that's what we're going to talk about today. So let's first talk about this concept called internal controls and why it's important. It's really important that in business we have a system of internal controls to help us in monitoring our regular business activities. Managers and owners of small businesses often control the entire operation of the business. They know if the business is actually receiving cash or other assets and services that are being paid for. Okay? Most companies cannot maintain personnel supervision and oftentimes need to rely on a system of internal controls. It's super important for management to monitor and control business activities. All right. Internal control systems and policies is a set of policies and procedures designed to protect the assets, ensure reliable accounting, uphold company policies, and promote efficient operations. Now, think about those things for just a second. You know, that first one, protecting the assets. What do you think here? What kind of assets am I protecting? What kind of assets am I protecting? Feel free to answer that question. You know, what kind of assets am I protecting? Any thoughts? What kind of assets do I need to protect?
Cash.
Yep.
Money.
Steven, say it again.
They said cash. I said money.
Yep. Jaden, cash. Steven, money. Absolutely. Got to protect the cash. How do I protect the cash? I put it into the safe, right? It's locked, lock and key. It could be in a register locked up. It can be in a safe locked up. Got to protect the cash. What else am I protecting? Think about the other assets the business has.
Inventory.
Inventory, definitely, Giselle. Inventory. Got to protect the inventory at all costs. You know, got to make sure that my inventory is protected. Yeah, cash, inventory, the building itself, maybe. Yep. You know, I got the way I protect my inventory is I have my perpetual inventory system. I use barcodes. I do my inventory counts once a year, sometimes twice a year. That's how I protect my inventory. Sometimes if it's high value inventory, I got it locked up. I got it locked up in a safe or some type of storage area, and it's locked up. You know, the expensive stuff. Like you go to Macy's, right? My favorite store, Macy's. You go to my favorite store, Macy's. What do you see? You see the perfume is locked up. Why the perfume locked up? Because very expensive asset. Yeah. Very expensive inventory. You might go to another retailer and you'll see that they have other types of inventory that are locked up. There's a few reasons for this. One is that it could be a high target item, something that's commonly stolen. Or it could be a item that can easily go missing for whatever reason. It fell off the shelf, whatever. So
Like at Family Dollar, they got the dishwashing liquid. The dishwashing liquid.
there's
The
another
light.
reason for that. There's another reason for that one. So the dishwasher liquid, yeah. I can tell you that sometimes kids are really dumb, and they do really dumb things with dishwasher liquid. So that's why it's locked up. Not necessarily because it's a high dollar value item, but because people don't behave well with certain products.
What, be pouring the detergent into another one to fill it up?
No, kids were eating it for a while on TikTok.
Yeah, exactly.
Yeah, the little pad. I'm talking about the little pads, the little dishwashing pads you put in the dishwasher.
Yeah. The what do you call them?
The pod.
The pods, the
Tide
Tide Pods.
The dishwasher pods.
The dishwasher pods, yeah. Kids or younger people, even some older people, I don't know, misbehave on TikTok and YouTube and whatever else, and they decide to put these things in their mouths. Okay, don't put that in your mouth. That's not smart. Okay, so anyway, yeah, that's why stuff like that is also locked up. You'll also see other products that are somewhat controversial. I don't know if that's how you say the word. Controversial. Those types of products are locked up. Yeah. But the reason why they're locked up, it's all a part of internal control system. We need to protect the assets as the company. The second one is ensure reliable accounting. We need to make sure that all of our accounting entries are accurate. We talked about this when we talked about QuickBooks, remember? Very, very important to lock up the accounting, enter the accounting correctly, because oftentimes what we find is when there are errors made, it's going to overstate or understate sales, overstate or understate expenses. The balances might be off because of errors in the accounting. So part of internal control system is we have auditors. We have other ways of verifying the accounting is accurate and reliable. The third one is to uphold company policies. Very important part of internal controls because the policies help to guide the company forward. And of course, to promote efficient operations is a part of internal controls. We don't like waste. We don't want to waste time. We don't want to waste money. So promote efficient operations is part of internal controls. I think we talked briefly about this next one. This is the Sarbanes-Oxley Act of 2002. I think I brought this up in class maybe once or twice before. I want to say it was maybe like the second week. So what this act does is it requires managers and auditors of public companies to document and verify their system of internal controls. This act was created back in 2002 because some companies, most notably Enron and a couple of other ones, decided to have fraudulent transactions. They made false invoices to make it look like their sales were a lot higher than they actually were. And the reason why they did that was to attract new investors. That's obviously illegal. That is what we call fraud. And so to prevent that type of thing from happening again, Sarbanes-Oxley Act was created and requires publicly traded companies to have a set of internal control systems in order to ensure that the company's assets are safeguarded. They have accurate accounting that's regularly audited, etc. Very, very, very important. So back when we talked about the Enron situation, I think we talked about that a few weeks ago. I had mentioned that the higher ups, CEO, CFO, CIO, a couple of other positions, they went to prison. There was also kind of like a murder-suicide thing that was involved in that case, and a couple of other things. So that's why this Sarbanes-Oxley Act is really important. It helps to prevent investors like you and I from being defrauded in the future by publicly traded companies. This organization, committee of sponsoring organizations, helped to create a adequate system of internal controls whereby they help to create a framework for companies to follow. And a good set of internal controls will have these 5 components. The first being a control environment. This is the company structure, ethics, and integrity for internal controls. The second one is a risk assessment to help to identify, analyze, and manage risk factors. The third one is control activities, which are the policies and procedures implemented to reduce risk of loss. The fourth one, information and communication. This are reports to internal and external parties. And the fifth one, monitoring, which is the regular review on the adequacy of the internal control process. Very important that your set of internal controls at your company has these 5 things. Pardon me. A little bit of water. I talk too much at my job, which is teaching. Right? Okay. Principles of internal controls. The idea behind the internal controls is that we are establishing responsibilities, maintaining adequate records, ensuring assets are bonded to key employees, separate record keeping from the custody of assets. I'll talk about all these things here in a second. 5, divide responsibility from related transactions. 6, apply technological controls. And 7, perform regular and independent reviews. I'm going to very quickly apply these 7 things to my experience, and I'm going to tell you about that. My experience as a financial controller for one of the largest hotels in New York back in the day when I was doing that kind of thing. So, man, that was back in 2011. What was when I was doing these things for a very large hotel in New York. So the first one, establish responsibilities. These are kind of like what's in the job description of each person that works at the company. So, for example, at the hotel, we would establish responsibilities for people that work at the front desk, front of house, back of house, the restaurant, the bar, etc. So who's responsible for what? Really, really important. Especially for management. It's important to designate which managers are responsible for which activities. So that was the first part. Second part, maintain adequate records. So in the hotel, in my hotel business, in my hotel, maintaining adequate records was absolutely paramount, and not just in the accounting office, but also throughout the hotel, right? So in the accounting office, our adequate records was we had a paper trail for every bill that was paid. For example, when we completed a purchase order for our vendors. I'll give you an example of this. We needed to purchase new linens for a couple of guest rooms from one of our vendors. The vendor was, we'll say Cisco, very, very large company. So we approached Cisco, said, hey, we need X number of linens. And so we would complete a purchase order, send the purchase order to Cisco. The purchase order was verified by myself and the assistant controller, and the person that working in accounts payable. So we send the purchase order to our vendor. The vendor fulfills the purchase order by shipping us the linens. Inside the package is the packing slip. The packing slip was matched to the quantity and the quality of what was received. That packing slip was then attached, stapled to the purchase order. A few days later, we would receive the invoice through email. We would print out the invoice and staple that to the purchase order and packing slip. So you see what we're doing here. We're creating the paper trail. And then when we were ready to pay, the accounts payable person would print the check out, and it would be paper clipped to the purchase order, the packing slip, and the invoice. And then the general manager of the hotel and myself would sign the check, 2 signatures. And accounts payable would then photocopy the check, take the check out, and send the check out. The check would be then mailed out through a different office. It would be mailed out through the general manager's office. And the records we would have kept are the invoice, the packing slip. The purchase order, the packing slip, the invoice, and a copy of the check that we sent. That's maintaining accurate records. The reason why we did it that way is because if there was ever a concern, a question about who sent the check out, when the check was sent out, or whatever, we got audited. Was this actually paid? Here's the evidence, right? In business, you have to have evidence of these transactions. Just having them in QuickBooks these days really isn't enough. I know with Curtis's business, for example, Curtis has his general contracting business. He uses QuickBooks. Stephen, I know you and I talked about this as well. I know, with your operation using QuickBooks, right? So it's not just a matter of having good records in your QuickBooks system. You also need to have your paper trail, right? So having that level of documentation is really important, because God forbid you ever get audited. You want to be able to prove everything. And so maintaining those records is paramount in business. The way I look at this is you need to have a paper trail in order to verify. And, if the IRS comes knocking, they're going to want to see it, and you're going to need to prove it. So just keep that in the back of your mind. But that was my
documentation beats conversation.
Hey, all day long. It really does. It really does. No doubt. For sure. But yeah, that was my experience at the hotel when it comes to the records. Insuring, now, number 3, some of you might not be familiar with. Insure assets and bond key employees. Here's what this means. In business, and Stephen, hopefully you have this. I'm sure you probably do, but if not, you might want to consider it. And I know that Curtis does. I know that Joe Curtis does. You really need to make sure that you're insured. Your business is insured. All right. I always recommend an umbrella policy. An umbrella policy is a form of an insurance policy for businesses that cover up to X million dollars in liability. For example, God forbid somebody sues you or sues your business, you're insured. The insurance is going to go to bat for you. Okay. Somebody trips and falls at your store. That's a problem. Okay. It happens. We are insured. Somebody damages your inventory. Insurance. Okay. Insure your assets. The second part of that is what we call bonding key employees. Here's what this means. The company takes out an insurance policy on the employees that have a key to the business. This could be like, your CEO, CFO, CIO, whoever's, but it could also be like your frontline employees that actually have a key. So think about a retail operation, right? Somebody has the key to the front door, right? Whoever's got that key, that employee should be bonded. A bond is a legally binding contract agreement between the employer and the employee, and it's also a form of insurance. That's what we mean by bonding key employees. Critical to protecting your business. Okay. So that's what number 3 is. Number 4, separate record keeping from the custody of assets. The same person counting the cash in the drawer at night should not be the same person depositing the cash at the bank, and sure as hell shouldn't be the same person that's documenting the receipt of that cash. You want to separate those duties. Keep them separated by 2 or more individuals. Someone's taking care of the accounting. That person should not be the same person depositing cash at the bank. Okay, I know it's difficult if it's just you in the business. You can't separate yourself, but you're probably also not going to steal from yourself. Okay, but if you have 2 or more employees, it keeps things on the on the up and up. So if you have 2 or more employees, you want to make sure that your duties and responsibilities when it comes to who is maintaining the cash is not the same person maintaining the books. Okay, so keep those separated. Divide the responsibility for related transactions. Number 5, the same person cutting the check should not be the same person entering the transactions into the system. Sometimes
like payroll.
Yeah. Payroll's always separate. Always separate. You always want to make sure that your payroll is separated from all other accounts, and you will need to make sure that whoever's entering the time is probably not the same person cutting the checks. Okay, you want to keep those separated. Yeah, that's the division of responsibility for related transactions, exactly. The 6th one is to apply technological controls. This would be things like security cameras and modern time clocks. A lot of time clocks now, they have fingerprint readers on them. All right, so in other words, you can't call your buddy who you work with to punch you in. Okay, a lot of time clocks have fingerprint readers.
Like a POS system.
Like a POS system.
I'm just trying to get like a. Okay.
Yeah, exactly. Yep, that's modern technology. Yep, POS system, security cameras, fingerprint readers, etc. Facial recognition software. That's becoming more common in employers. And then the last one is to perform regular and independent reviews. It's important to have someone inside the company taking a look to make sure that everything's accurate, and someone outside the company to take a look and make sure that everything's accurate. So those are the 7 principles of internal control that I strongly encourage you, especially if you currently own or manage a business, to make sure that you have those 7 principles in operations. Establishing responsibilities, as I had mentioned, should take place clearly established, who's assigned to do what, and what this does is helps us to determine who's at fault when something goes wrong. Because you don't want to be pointing fingers, but at the same time, you need to hold people accountable, wherever they need to be held accountable. Maintaining those adequate records. I talked about my process, the purchase order stapled to this packing slip and the invoice and a copy of the check. Right? All those things, super, super important. You want to maintain detailed records. If you get audited, you need to be able to prove it. Bonding your key employees, as I mentioned, the company's insuring against loss against the person who has the key. It's a bond between the employee and the company. The insurance is going to, the policy is against any theft from the employee that holds the key. Go ahead, Giselle.
Since there's a kind of like an insurance for the employees that have a key, is there also an insurance kind of situation for employees that manage the money?
Yeah, definitely. Yeah, we bond those employees the same way we bond the key holders. In most cases, yes. I would say almost in all cases. Some companies, it depends, obviously, in the organization, but yes. So, for example, I'll give you my grocery store experience when I was 15 years old, working at the grocery store. Okay, my very first job. Well, besides stocking the shelves, I was also oftentimes running the cash register, and the company made me sign a bond agreement, and basically it was insurance where if I decided to walk home with all the cash, that the company was at least insured against me doing that, right? So yeah, to answer your question, yes, the people handling cash should also be insured in that regard.
Thank you.
Yeah, definitely. You're welcome. So yeah, that's bonding and insurance. Separate record keeping from custody of assets. Person counting the cash should not be the same person recording the receipt of that cash. Okay, you want to make sure that we keep as much of that separate. The reason why, and I've seen it happen. I witnessed it happen. Sometimes employees will work together to commit fraud. So let me give you an example of this when I saw this happening. At the hotel, the bar at the restaurant was notorious for theft. The bartenders, sometimes they wouldn't bring up the drinks properly, or they might use like a voucher or whatever from the front desk. And I've watched bartenders do this together. They'll tag team the operation. And, obviously, anytime that there's cash involved, there's a high propensity for theft. And so in order to reduce that from happening, what we implemented is at the end of the night, whoever's counting down those drawers, there's somebody else there. There's somebody else watching. There's somebody else recording it. So it helps to control the assets. Divide responsibility for related transactions. It's kind of like what I had mentioned. The one person cutting the check should not be the same person collecting the cash, right? These duties should be separated. For example, in our accounting office at the hotel, I had one person responsible for paying the bills, the accounts payable person, and I had one person for accounts receivable. Always separate those two. Always separate those two. So if you have a larger operation, you got a couple of people in your accounting office, you want to have one person for accounts receivable, one person for accounts payable, and then a third person for payroll. Okay, that's the way our accounting office was set up at the hotel. I had one person for accounts payable, one person for accounts receivable, one person for payroll. And then there was me and then the assistant controller. That's how you want a solid operation in the accounting office. Separation of duties. Technology.
What?
Go ahead.
I was about to say, can you repeat that again?
Oh, about having the separate duties, responsibilities?
Yeah.
Yeah, for any good operation, you want to, especially in the accounting office, if you have the manpower, is that you want one person responsible for accounts receivable, a separate person responsible for accounts payable, and then another separate person responsible for payroll. It's super important to keep all those things separated because you don't want the same person collecting cash being the same person paying. You see what I'm saying?
Okay. Yeah.
Yeah, you want to keep those separate. Yeah, awesome. For technology, I mentioned the new time clocks. They have fingerprint readers, retina scanners, facial recognition, etc. So that's an example of technology for time clock control. The cash registers are very modern, so they track all the transactions and record each sale. For larger retail operations like Macy's, in order for a cashier to try to void a sale, it requires manager approval. Right? So if you've ever been to a retail store and you see something like that happening, the manager usually comes over and they have to enter a code in order to allow that part of the transaction to occur. I've seen the same thing happen where, like at another retailer, where you can't hit the no sale button. It requires a manager's approval. Or let's say a customer is coming back and they're returning something and they paid cash. Okay, in order for that return to go through, manager comes through and has to enter the key. You see, what that does is it's preventing any type of, opening the cash register for no reason. You see, so really, really important. It's part of technological control. Regular independent reviews. Someone internal goes in and audits, making sure that everything's on the up and up, and having someone outside the company come in and do an audit. All right, internal and external auditors. They're reviewing, making sure everything's correct. The reason why, or what came from all of these things, the technology, the detecting fraud, the internal control processes, it helps to reduce processing errors, provides more testing of records, making sure that they're accurate, promotes the separation of duties. It led to an increase in e-commerce or purchases online. And it also provides a new evidence of processing. So these are just kind of like the benefits of what came out of improved technology, the fraud detection, and internal control processes. I want to briefly talk about blockchain. I would suspect by now most of you have probably heard of blockchain and what it is. It's relatively new. It's a more secure type of an accounting ledger. Blockchain ledger is continuously and simultaneously updated and verified. The blockchain technology makes it difficult for the ledger to be modified without a detailed record of changes. The records cannot be destroyed or hidden because their record is shared and stored on by multiple users. So the way I think about blockchain is that it's very secure. It's a way to record these transactions. They're verified relatively instantaneously, and they're continuously updated. It prevents modification. Changes can't be made, destroyed or hidden, and the auditors can focus on testing its efficiency. So blockchain technology has really led to an improvement in the overall security of accounting systems. Oops, sorry. Some limitations of internal controls is that we all make mistakes, right? If you're human, you've probably made a mistake or two in your life, I'm sure. We all have. I know I've made plenty. I'm sure that we all have, right? So sometimes we can be somewhat careless, maybe misjudging or confused. We all make mistakes, human error. Sometimes people act intentionally or unintentionally by committing fraud. It happens, you know. They try to game the system. So these are sometimes limitations of internal controls. There's the fraud triangle we talked briefly about, I think, a few weeks ago. If there's an opportunity, pressure, and rationalization to commit fraud, it will happen. Right? Those three things typically have to exist together in order for fraud to happen. And then there's a cost-benefit constraint. The benefit must always outweigh the cost for establishing internal controls. So these are just some of the limitations. So now we've got internal controls and fraud out of the way, let's talk more about cash, because cash is king. Cash rules the day, it runs the business. So let's talk about how we control our cash, especially now that you know about internal controls. Cash is easily hidden and moved. It's the most liquid asset that the business has. All right. So we need to make sure that we have an internal control process for handling cash. An effective system of internal control is a part of the process that protects the cash and cash equivalents. There are three parts of this. Number one is handling cash is separate from the recording of the cash. In other words, the same person counting the cash should not be the same person entering the transaction into QuickBooks for the cash. Okay. Number two, cash receipts are promptly deposited into the bank. Don't wait a couple days. Don't wait until the weekend ends. Do it right away. Okay. Well, you have to maintain the integrity of the cash. Now, it's okay to leave the cash stored overnight in a safe, but don't let it sit there too long. You want to make sure you get it to the bank quickly. And number three, cash payments are made by check or electronic funds transfer. That's a very old term. I mean, it's old these days anyway. A check is this paper thing that some of you are probably way too young to even know what they are. But believe it or not, back in my day, we used to have to write out payments on this paper called a check. And it would have who we're paying it to, the dollar amount, what it was for, and then we would sign it. And then we would mail it to pay our bill. So that check, is a great way to pay. And it still is a great way to pay. Reason for that is because, once again, there's a paper trail. And it's a lot more secure than cash. The number one thing I can tell you is that never put cash in the mail. All right. I know that my grandmother used to, send me a $5 bill with a birthday card in the mail. That's risky, Grandma. Don't do that. I used to tell her. Oh, it's okay. I said, well, you don't know the mailman. Right? But the point is, don't put cash in the mail. All right? Way too dangerous, because something happens to that cash, it's not insured when it's in the mail. All right? So don't pay your Pepco bill in cash. Don't do that. Write a check. All right? Check and electronic funds transfer, all that means, electronic fund transfer from one bank account to another online, pay your bills online. That's what we call EFT, electronic funds transfer. I usually don't carry cash with me anymore. Very rare. It's good to have some on you, but I prefer check or a card, just because it's more secure. Yep. Cash and similar assets are called liquid assets because they can very quickly be converted into cash in order to pay liabilities. Okay. Cash includes things like currency, coins, and other deposits in the bank accounts. It also includes things like checks, cashier's checks, certified checks, and money orders. All of these things are considered cash. Right? I could quickly convert a check into cash. Money order into cash. It's all cash. Cash equivalents are what we call short-term, highly liquid investments. These can be converted into cash quickly. They are close to their maturity date and not sensitive to changes. Example of cash equivalents, I can tell you, would be things like a bond or a stock. These are short-term investments that can be quickly converted into cash. Have a plan for managing your cash in business. Plan cash receipts to meet cash payments when they're due. Oh my God, this is so important in business. I got to tell you, like the most important thing. Once in a while, I'll come across a small business owner that is struggling to pay their bills on time. And so I asked them the good old question, how much cash do you have on hand? And oftentimes they tell me not enough. And I ask them, why not? What's going on here? And they tell me, well, I got customers that are slow to pay. All right. I know that Joe Curtis and I, last week, we talked a little bit about this. Customers can be slow to pay sometimes. 30 days, 45 days, 60 days. Yeah, that's, problematic for a small business owner. And the reason for that is because you need cash to pay your bills. And you need to know when your customers are paying you. So plan it out. If you know the customer is going to pay you in 30 days, expect that payment in 30 days and plan your bill to pay your bills accordingly. Right? You always want to make sure you have enough cash on hand. Which leads to number 2, keep a minimum level of cash necessary to keep the business going. I'm just going to call you KC because it's kind of fun to say. To KC's earlier point, you want to make sure when it comes to payroll, have a separate payroll account. Must have. In most states, they require you to have a separate bank account only for payroll and to maintain a certain amount of cash in that account. at all times. Effective cash management involves applying things like the encouragement of collection of receivables. We talked about the discount, right? The 210 net 30. I'll encourage you to pay your bill early by offering you a 2% discount if you pay your bill in the first 10 days. Otherwise, all things due in 30 days. That's an encouragement to collect accounts receivable. I love this next one. Delay the payment of liabilities. My uncle was notorious for this one. He had a saying. He said he would receive all these bills in the mail. And I asked him, I see him stacked up on his dinner table. I said, what are you doing? He goes, I'm organizing my bills. I said, he's got them stacked into 3 different categories. I said, what the hell are you doing here? I don't get this. He goes, I have a system. I said, what's your system? He goes, pay, delay, and throw away. And I didn't quite think of, like, I just thought it was funny. I mean, but that was what he was actually doing. And I'm like, what do you mean pay, delay, throw away? He goes, well, I'm going to pay these bills today in this stack. I'm going to delay paying these ones. And I don't care about those ones. I'm going to throw them away. That's okay. He goes, that's my system. That's how I manage my cash. It makes sense. Now, I don't recommend that you throw bills away or even delay paying them. But in some cases, you have to, right? It's like your payday is on Friday. You got a couple of bills that are approaching a couple days late, but you can't pay them because you don't have enough cash. You got to delay. You got to delay paying them. Not great for your credit score, but it's better than the alternative, right? So companies usually will wait to pay their bills until the last day possible. Yep. Pay your bills when it's due. Why? Because having that cash on hand can help you. Keep only necessary assets. Get rid of expensive stuff. You don't need it. If you don't need it, sell it. Yeah. Keep only necessary assets. Plan for expenditures. When your bills are due. You operate on a regular cycle. Rent's due at the first of every month. You know that. Car payments due the first of every month. You know that. Insurance due the first of every month. You know that. Plan your expenses. Create a budget. And invest in cash. Invest your excess cash is what I mean. If you have extra cash, number one, good for you. You got extra cash. But number 2, make that cash go to work for you. Make it earn some interest. High yield savings account, whatever. So that's my story on cash in terms of controlling them. Let's talk about our cash receipts and payments. I had mentioned several times throughout the past few weeks that our customers pay us in more than one way. You know that already. Some of my customers will pay me right over the counter in cash. Pay me at the counter. Just like the Macy's story, right? They come to the counter, they pay cash, they walk away. We also have some other customers that pay us through accounts receivable. They're going to pay us 30 days later. But let's talk about the ones that pay over the counter. Here we can see a nice illustration of us receiving cash over the counter. This reminds me of the hotel days. Over-the-counter cash sales should be recorded at the cash register at the time of the sale. Customers should get a receipt. They always ask you, would you like your receipt? Take the receipt. Cash registers provide a permanent record, locked in record for each transaction. The register is linked to the accounting system in most cases, and it should be. Less advanced registers print a paper tape or electronic file is stored within the register. Now, back in my grocery store days, we used to print out the tape at the end of the night. Back then, cash registers weren't all that smart, right? So I would turn the key to what we call the Z tape at the end of the night, and it would print out all the transactions that occurred throughout the day on that register. And we would do that, and we would then go to the accounting system and enter it in. Okay. It's part of the process. Remember, the same person counting the register at the end of the night should not be the same person recording it in the accounting system. Let's talk about this one. Oh my goodness. Oh, okay. Well, first let me explain this graph real fast, and then I'll talk about the next one. We received the cash over the counter at the end of the night. We print out the tape from the register. I put the register tape, I put the cash, and a cash sheet that has a recording of how much cash is in it, who's sending it in, etc. Put that in a nice security bag. I put that in the safe. The next morning, the sales department collects it, records it in the accounting system, and the cash goes off to the bank. That's the process. Let's talk about this one. Oh my goodness, I used to be so scared. When I was, 15-year-old me at the register. Sometimes I wasn't always great at counting. Maybe a bill would get stuck, right? Or the customer give me too much money, or didn't give them enough money. Hey, it happens. So let's talk about overage. This would have happened if I didn't give the customer enough change. Whoops. You can get in trouble with this stuff. Okay, so here's the error that happened. I was at my cash register. At the end of the night, I made $550 in sales. I printed out the Z tapes at $550 in sales. I counted the cash drawer. I had $555 in cash. Something ain't right here. So I need to record a journal entry for this. I debit cash $555 because that's what I have in cash in my register, $555. I credit sales $550 because those are the sales I actually made. What do I do with the extra $5? I credit this account called cash over in short because I was over my cash balance by $5. You see, it happens. We all make mistakes. But I can tell you that if this happened at my store, you'd get in trouble because you didn't give customer change, right? You got to be as close as possible to exact. Now, what about the opposite? Oh boy, gave too much change. I've done this before too. Here's what happened. I made sales of $625 according to my cash register. I count the cash register and I come up with $621 in cash. Whoops. I forgot to give $4 in change to a customer. All right. So I need to record the following transaction. I debit my cash $621 because that's what I actually have in the register. I debit this account called cash over in short by $4 because, hey, I actually only have this four extra dollars. Or no, I gave, what happened here? I gave too much cash. That's what happened. I gave extra $4. So I debit cash $621. I debit cash over short $4. Means I'm short by $4. And I credit sales $625. It happens. Earlier, I had mentioned never put cash in the physical mail. Don't ever do that. Not smart. Okay. Checks, that's okay. Don't put cash in the mail. At the hotel, when we would receive checks from customers or whatever, we would always have 2 people assigned to collecting the mail. All right. The reason why? Because, things happen. Things disappear. Have 2 people collecting the mail. The cashier deposits the cash in the bank. That's one person separating the duties. The other person recording the amount received in the accounting records. Separation of duties. Very important. Control your cash payments. Make sure that you always have enough cash on hand, obviously, to make your payments. A couple ways to control cash payments. Require that all payments are made by check. All right. At the hotel, I never paid a single bill in cash. It was always done by check. The check is a record. Okay. Limit the access to the accounting records except for those that have the authority to sign the checks. Yeah. And always have a cash budget. A cash budget shows us how much cash we expect to receive from our customers and how much our bills are that we expect to pay. The cash budget usually also tells us when these things are going to happen as well. We had, and this goes back to the system of controls I told you about. For every bill that I had paid at the hotel, it all started out with a purchase order. I sent the purchase order to the vendor. The vendor sends me the inventory that I purchased. With the inventory comes the packing slip in the box. A few days later comes the bill, the invoice. A few days after that, I need to print the check out. 2 people sign the check. Copy of the check gets attached to that series of documents. The purchase order, the packing slip, the invoice, and a copy of the check. That was my voucher system of control. That's what that record showed me. It's traceable, it's auditable, and it's reliable. So what does this system do? It verifies, approves, and records liabilities for eventual cash payments. Issues checks for payment verified, approved, and recorded in the liabilities. Very, very important to have that paper trail. Here's what it looks like. Nice visual representation of that paper trail. But you see how it works. The purchase order, the packing slip, the invoice, the check. Right? That was on the sending side. On the receiving side, they should have, once again, the purchase order, the invoice, the receiving report, invoice approval, and the check. Yeah. Very, very, very important to have that paper trail. Next thing I need to talk to you about when it comes to cash is this concept called petty cash. Petty cash, as the name implies, is petty, right? Very little, very little. Sometimes at the hotel, at the front desk, I would always have $100 in cash. And I'll be in this lockbox in the back in the front office manager's desk. It'd be locked up. There'd be $100 in cash. Now, why do you think I would do that? Couple things, right? In business, especially overnight, we need to do small things. Shipping out letters for guests at the hotel. Yeah, okay. I need to buy stamps for shipping. Minor repairs. I think one time a guest had broke a vase of roses in the lobby. Minor repair. I got to replace that vase. So somebody from the front desk ran over down the block to Home Goods, buy a new vase. Right. Low cost supplies. I need pens. I need a stamp, whatever. Small stuff. So I have a petty cash drawer, $100 in the lockbox in the front office manager's desk at the hotel for these kinds of things. And as the cash is used, the front desk employees will bring the receipt, exact receipt, and change, put it into that lockbox. So I'll show you how we record it and how it all works. The first thing you want to do when you establish a petty cash fund is to debit petty cash. It's a cash account. Debit petty cash and credit cash. All you're doing is you're creating a separate cash account only for petty cash in your accounting system. As the cash is $5, as the cash is being used throughout the month, receipts are coming in for that, the physical receipts from the stores or the transactions are coming in, okay, or small invoices, whatever, for various things. We had to pay for some inventory, $15.05. Okay, took it out of the petty cash funds. Real small, quick, and easy transaction. I needed office supplies. Okay, great, $4.75. A customer needed a package delivered, $5. Okay. Somebody came in to clean the tiles in the lobby, $46.50. So throughout the month, I spent $71.30 of that $75 petty cash fund. So here I can see all my receipts, right, from my various reasons of using the cash. Anna, I see your hand, please.
Yes, I had a question.
Yeah.
I do farmers market often, right? And I always keep in my little box, my little cash register mobile.
Great.
Yep. $50 because sometimes customers bring a bigger bill. So that money always, I know that when I count the money, I have to have a separate 100. That one is considered petty cash as well?
So that will be different, Anna. So for your situation, if that's a part of the business, which is a farmer's market, if you're setting up shop and you're selling, that would just be a regular type of cash drawer, right? So for your accounting, you might want to have you might want to call it like a cash register drawer to identify how much cash is maintained in that drawer. So for example, when I was working at the grocery store a long time ago, I would always have $250 in cash in that register at all times. Okay, and at the end of the night, anything over that amount was taken out and deposited to the bank. And so, to your point, for your accounting system, you'll probably, for that type of business, you're going to want to have identified separate cash account, call it cash register drawer for and designate it, for farmers markets or whatever. So that way you always have that cash balance. And then anything over that, you'll take out and deposit to the bank. That's the way I would do it for yours. Yeah. But if you were purchasing small things for your farmers market business, if you were purchasing small things like a vase or for flowers or like a tablecloth or I don't know, something small like that, then yeah, you could do a petty cash fund for something like that. But it has to be separated. That's my overall point.
Okay, thank you.
Yeah, great. Yeah, thank you for the question. Excellent question. So yeah, here we have all of our cash receipts, and then we have a reimbursement. So I have to remember I started with $75. I need to refill that $75. So what the accounting office does at the end of each month is we take all of the receipts that are in that bag where the $75 originally was, and I document everything that happened in my accounting system. So I debit inventory $15.05, debit office supplies expense $4.75, debit delivery expense $5, debit miscellaneous expense. Hey, I don't like miscellaneous expense personally. Some businesses use that account. I don't like that account. I want to know exactly where the money went. I don't want to see miscellaneous. That's just Dr. B, okay, being picky. But a lot of businesses use miscellaneous for other things, $46.50. And then we credit cash $71.30 to reimburse the petty cash fund. That's the process. And then sometimes you want to increase or decrease the petty cash fund. It's real simple. All you're doing is you're either debiting or crediting petty cash and crediting your cash account. Yeah, very, very simple. And just like before, if that petty cash fund is over or short, that needs to also be accounted for. So we would debit or credit the cash over and short account when that happens, just like we did before. Banks are very modern these days. They offer things like checks, bank accounts, signature cards, deposit tickets. Those are the slips that go into the bag when you deposit to the bank. Tells you the amount of currency and coins, etc. The bank statements where you see once a month. You want to use that to reconcile your bank account. Match your physical bank account with your accounting information system, your QuickBooks. We do that through bank statements through the reconciling process. And electronic funds transfer. All these things are offered by banks. Deposit ticket looks like this. We separate the amount of currency from coins and list out any checks being deposited on the other side. These are what go to the bank with the actual cash and checks. Serves as proof of deposit. I always keep a record of all these things, just in case you ever get audited. A check looks like this. Who's making the check, who's being paid to, the amount, what it's for, all those type of things go on a check. Again, provides evidence. Most checks will either have what we call a carbon copy, thin copy on the back, it's kind of like an imprint, or it'll have what's called a remittance advice. So if you've ever received a check in the mail from, I don't know, a tax return or whatever, oftentimes you separate it, right, from a small piece of paper. That small piece of paper, we call it remittance advice. And what it is it's a description of what the check is, what it was for, and how much it was. Hang on to that. That's part of your paper trail. This is what a bank statement typically looks like. You'll notice it has the dates of transactions, cash going in, minus your cash going out, and your balance updates accordingly each day. You'll also notice that the bank statement, it's not always going to show you all the checks because some checks haven't been cashed yet by the person that received them. It's only going to show checks that have been cashed. The checks that have not been cashed, we call those checks in transit. But you'll notice it starts with a beginning balance, withdrawals, deposits, and the end of period account balance. And when we go through, and I try to do this every single month. Every month I do what we call a bank reconciliation. I'm matching what's in my QuickBooks to what I actually have in my bank account. This makes sure that I always know exactly how much cash is on hand for the business. So very, very important that we do this on a regular basis. Bank reconciliation is a report explaining any differences between the checking account and what's on your accounting information system. So when there's differences, oftentimes it's because of checks that are in transit. any types of outstanding checks, etc. And also sometimes banks will charge you fees or there might be an error. So we need to make sure we adjust for those things. Bank balance, make sure that everything is in balance. So we start with the cash balance plus deposits in transit minus checks outstanding plus or minus bank fees and errors equals the adjusted cash balance. We do that same process for both for the accounting information system to match what we have in an actual bank account. This these first 4 steps shows us the process. So bank statement balance plus any checks in transit minus any checks outstanding equals our adjusted bank balance. That's the first 4 steps. The next 5 steps, well, we take the book balance, that's our accounting information system. We add in collected amounts plus any interest earned, and we subtract out charges, etc. That gives us our adjusted book balance, and that's how we reconcile, we match our bank statement to our accounting information system, our QuickBooks. And these are the types of adjusting entries that I would make in order to get those reconciliation process to balance. One be things like collection of notes, interest earned, printing checks, non-sufficient funds, etc. And then, of course, I can't let you go until I've told you about at least one ratio because they're your favorite and you love them. This one is called Days Sales Uncollected. Tells us how much time is likely to pass before we receive cash payments from our customers based off of our credit sales, also known as account receivable. How long it takes to collect our account receivable. We take accounts receivable total divided by net sales times 365 days. Tells me how long it takes to collect from my customers on average. Obviously, the smaller the number, the better in that case. And this just kind of goes, again, back to that, the process. Documentation and verification. The paper trail. Super, super important thing in business. Invoice approvals, vouchers, etc. Questions, comments, or concerns? Sorry, we went a few minutes over. I just want to make sure that you're all satisfied with the presentation I've delivered today. Are we all good?
All good.
All right.
Yes, we're good.
Great. I didn't want to bore you all to death, but I'm happy that I kept it real with you because that's really my intent, is to make you all awesome managers. So just as a real fast reminder, what we have to do by Sunday night: 3 action items, 3 things you got to take care of. Some of you already started. Thank you for doing that. 3 things I need you to do by Sunday night. I have an Excel for Accountants LinkedIn Learning certificate. Oh, so several of you have done it already. Thank you. Knock it out. It should take you about an hour and a half, roughly. We also have the Chapter 8 quiz. After you've done those 2 things, start taking the midterm exam. The midterm exam is open book, open note. I have this review video right here for you. Open that up and watch the video, because it's a combination of what you just learned plus where to find information to assist you in answering questions on the exam. So please make sure you watch that recording. Really, really important. It's right here, midterm exam review. Do that as you're taking the exam. You can open the exam, answer the first 5 questions from Chapter 1, then close it. Open it again with your PowerPoint presentation from Chapter 2, answer the next 5 questions from Chapter 2, close it, save and close, open again. You can do that as many times as you like. Take breaks, etc. It's not timed. It covers the first 8 chapters. It's not timed, about 5 questions from each chapter, and it goes in order. open up your PowerPoint presentations and review your prior quizzes that you've taken from each chapter. You'll notice that your quizzes are very similar to the questions you'll see on the exam. You do those things, I promise you'll score very high on the midterm. Okay, but please make sure we do those 3 things: the LinkedIn Learning, the Chapter 8 quiz, and the midterm exam must be completed by Sunday night. The midterm exam, I cannot accept late. I just want you to know that. Midterm exam must be on time. Comments, questions, concerns?
Are we meeting in person on Thursday?
No, we're not meeting at all this week. This is our meeting for this week.
Okay, thank you.
You're very welcome. Any other comments, questions, concerns?
Real quick,
Yep, Steven.
which Excel learning is it on LinkedIn?
Yep, so log into the classroom under week 8, click on Engage and Explore, and this one is Excel for Accountants. You're going to open up the Excel for Accountants. It'll open up like this. Should open up like this. You're going to do just like you did before. Start with the introduction, go all the way through. Each video will have a green check mark when it's been completed. Every video must have green check mark next to them as is completed. Once you got to the very end, you've watched the conclusion video, a certificate will pop up. Make sure you enabled your pop-ups. You could also select this one that says certificates, show all. You're going to download the LinkedIn Learning Certificate as PDF, and then you'll upload that to the classroom here where it says Excel for Accountants Certificate. Make sense?
Yep. Thank you.
Perfect. Very good. Great. Anything else before I let you all go? Okay, awesome. Thank you all so much. I really appreciate all of you. I know you'll do fine. Don't you worry about a damn thing. I know you'll be perfect. As you have been throughout the past 8 weeks, you got this, okay? So I already have some recordings I posted through the message yesterday, I think it was. I'll post this recording. If you need anything in the meanwhile, shoot me an email. I'm here for you, okay? I got you. Thank you all so much. Let's go get them.
Thank you. Have a good night.
Have a great night. Take care.
Enjoy the rest of your night.
Good night. Bye-bye.